We've been calling the two charts on the left the most important charts in market, the consensus forecast for new record margins in 2025 and 2026 look to be too aggressive.
The economy either looks just fine or looks to be on the brink of something seriously bad. Think about what this black line is likely to do in the face of much, much higher levels of trade uncertainty. We were not favorably disposed toward corporate bonds. Those spreads have widened out following the Liberation Day tariff announcements.
The earnings power of that higher quality segment is certainly stronger than the broader market.
I'm going to flag just a few important charts, just talking about a few fulcrums, these kind of ideas of real big pivot points within markets of what could be important movers. And this to us is probably the most important story in all of markets. And it's that we are living in a very different world for growth expectations. We've been calling the two charts on the left, so the first and the second chart, the most important charts in markets over the last 2 years. The last 2 years have been defined by rising growth forecasts for the US economy. The US economy defying expectations to the upside, defying recession calls, and having this continued growth forecast being ratcheted up higher and higher and higher. That provided the backdrop for very strong returns for both equities and credit. Risk assets love forecasts going up. But this is very different today. Look at forecasts on the far right chart. They have fallen off a cliff. And those forecasts falling off a cliff reflect the economic reality that tariffs could weigh on growth. But probably even without tariffs, forecasts were likely too high given some of the dynamics and details that we outlined in our outlook, where some of the tailwinds to growth that we had in 23 and 24 were clearly fading. So this is a very different, brave new world when it comes to growth forecasts. The other important thing that feeds into this growth forecast and what we think is going to be a major kind of tilting shift of where this economy goes is where corporate margins go. We've been in a world where corporate margins have been extraordinarily resilient, making new highs. Of course, 2021, 22, getting to new highs thanks to inflation. Corporate margins were great in those years because there was inflation that could be passed on to consumers. And so one of the challenges we see for corporate margins is that as consumers have less ability to stomach higher prices, to take on those higher prices from companies are likely to have to absorb more of those costs onto their operating margins, which just means that the consensus forecast for new record margins in 2025 and 2026 look to be too aggressive. Two more quick things from me is one is on the dollar. We've seen distinct dollar weakness. And of course, this has come with the narratives of the end of US exceptionalism. And there's an interesting observation here, which is that the first half of the move of the dollar lower was really driven by positioning in futures. You started the year with a very crowded US long dollar position. That has now unwound, and now you're at a position where traders are slightly short dollars. But what you can see in that red line is we have undershot to the downside this dollar positioning in the futures market. It suggests that maybe there is dollar weakness coming from drivers of sellers in other places. It could be a function of the fact that if we are trading less, we have less of a capital surplus, which means that there's less demand for dollars. This, of course, has really important implications about the leadership within equity markets on a global basis. The only time you see big, huge bull markets in non-US stocks is when you have big, huge bear markets in the dollar. And so it's one of our reasons why we think that having a diversification between US stocks and global stocks remains a really important part of portfolio construction. So one last thing is just talking about treasury yields and the question of, are they decoupling from the growth outlook? Here you can see that treasury yields have been very strongly correlated to economic surprises. Economic data comes in weaker than expected, treasury yields go down. Economic data comes in better than expected, treasury yields go up. But over the course of the last week, you saw a big jump in treasury yields, but you were seeing deterioration in economic data. This suggests that there was certainly some positioning drivers. We saw some unwinding of some leveraged hedge fund positioning and swap spreads. We also saw potentially, there's theories that you are seeing some sellers of treasuries, and we'll talk about that in a second from foreign buyers, but you're also seeing potentially concerns about the fiscal situation in the US, given interest costs are now starting to eat up more and more of the US deficit, something that Brian can talk about as well in the policy section. So clearly we have a lot of volatility within the treasury market, and we don't expect this to end. So one last note just on the question of treasury yields decoupling is that there's a lot of talk and narrative about what's going on with China selling our bonds. So this is data through the end of the fourth quarter 2024, and this is data that captures the treasury holdings from different holders across the globe. What you can see is that Japan is the biggest owner of treasuries, even though it used to be about 10 years ago China. But for the last 10 years, China has been reducing its treasury allocation and reducing its overall size of treasury holdings. And so this is nothing new for China to be selling treasuries or not reinvesting as much as in treasuries. But again, this is only through the fourth quarter. So it'll be very interesting to see if there is a sharp downtick within Chinese treasury holdings in response to what's going on the trade front. The one thing that we would talk about, though, is that if you look at where there's been big buyers of treasuries, it's been in the UK and Canada. And both of those areas are big question marks. If we're trading with them less, will there be as much demand for treasuries going forward? Big, important questions as we move through the rest of the year. But it's important to kind of at least acknowledge that the story about China selling treasuries has been something that's been going on for more than a decade.
The economy either looks just fine or looks to be on the brink of something seriously bad, depending on whether you look at hard data, which is measuring actual economic activity, or soft data, which is mostly sentiment surveys, things that people say they feel about the current situation or about the outlook. And you can see here the surprise index is the degree to which hard data and soft data are either coming in ahead of expectations or short of expectations. There's a huge divergence here. Soft data has been disappointing almost uniformly. Hard data has been basically hanging in there, coming in more or less at expectations. You can see examples of this if we go one more slide up. On the manufacturer side, the New York Fed's survey of manufacturers, when you ask about their outlook for orders, what their order book is going to look like in 6 months, they have never been more pessimistic than they were in the survey we just got for the month of April. The downward spikes you see in the past were September 11th, 2001, and the global financial crisis in 2008. So we are on that level of pessimism when it comes to manufacturers' outlook. Even during COVID, we didn't see this level of pessimism. There was a sense that orders were very weak currently because the economy was shut down, but that they would be better in 6 months. Consumers are saying the same thing. When you talk about consumer outlook, the Michigan survey, which has a history of being very sort of politically polarized, so we break this out here by self-identified party ID, whether you're looking at Republicans, independents, or Democrats, everybody's outlook has deteriorated in the last 2 months. Whether you are despondent or merely not as euphoric as you were a few months ago, depends on your political affiliation, but the direction is very clear in terms of how consumers are grading the outlook versus where they were at the beginning of the year. So let's go one more slide forward. Just look at the hard data, which is telling you a very different story. The Dallas Fed has a weekly series that captures things that can be observed at a high frequency. Initial jobless claims, retail sales, and same store sales, the amount of raw materials being shipped around the country. And that continues to be not just solid, but arguably even strengthening a bit. Cameron talked about this. We could be seeing economic data actually appear to strengthen in the next month or two as we get data points from times when people may have been sort of front running or trying to front load purchases ahead of tariffs. But there's no sign here that we are imminently in recession, let alone in one at the moment. One other piece of hard data that we look at, well, this is, I mean, really what contributes to the confusion about the outlook. And you're seeing here's a polymarket betting odds on whether there's going to be a recession in 2025 is really close to a coin toss here in terms of how investors think about it. Because if you look at the soft data, you're very concerned if you take that seriously. And if you look at the hard data, you're not really seeing a reason to be concerned just yet. So let's look at the two major pieces of data that we think are going to be determinative for how we end up this year, but also the direction of public policy from here. First and foremost, the labor market. We are not seeing a big increase in the number of people reporting that they've become recently unemployed and are collecting unemployment insurance. It's come up a little bit, but not anywhere near where we see in terms of distress levels of labor market deterioration. And that black line, which is showing you continuing claims, that is higher than it was a few years ago when the labor market was very strong. Probably more reflects a weaker hiring environment, not an environment where a lot of people are being laid off rapidly. As you look at other areas of the labor market, you can see that this is the broadest measure we look at. So how many people are working? How many hours are they working? What kind of wages are they earning? Year over year, this is very, very consistent, very flat, not a concern here. It looks very much like most of the 2010s. when you saw this number annualizing at around 4 or 5%. As you move into the softer areas of the labor market, though, let's look at things like the quits rate. This is how many people are so self-reporting that they left their job voluntarily. That number has continued to come down as people feel less secure in the labor market, less able to find jobs other places, and that tends to be a leading indicator for wages. So we still think there's softening in the pipeline for the labor market, specifically when it comes to wage growth, which we know is the number one ingredient into consumer spending. This is not a function of the tariffs or Liberation Day. This is something that was already kind of baking itself into the cake to start the year. And then on the sort of the maximally soft side of the labor market evaluation, households' self-reported outlook for the labor market has almost never been worse than it is right now. Over 2/3 of households are saying they expect the unemployment rate to be higher a year from now, which is an extreme level of pessimism and a big jump from just what we saw the last 2 months. So again, hard data looks okay. Soft data should start to concern you. Let's look at inflation, another thing the Fed's going to be very concerned about. If we just freeze frame here in the month of March, it looked like inflation was moving down to, at long last, something that looks like the normal level based on sort of the pre-COVID environment. We saw, softer than expected inflation in the month of March. We think we're going to get softer than expected PCE inflation when we get that data at the end of the month. That's the thing the Fed really keys on. But looks like we were making progress here. But now look at this next slide. When you look at consumers' inflation expectations, they have gone through the roof. Now, 6.7% is probably quite extreme. I think people are internalizing a lot of the headlines, but it's very unusual to see inflation expectations spike like this in an environment where gasoline prices have been either flat or down across the country. Usually, those short-term kind of high-frequency purchases like gasoline and food, those need to be moving up in order for people's inflation expectations to move up. But here, it's undoubtedly about the tariff. So if you're looking at the recent data, looks okay. If you're looking at the sort of the leading indicators and what people are expecting, it looks much less good. This is the slide we showed in January. Didn't change any of the bullets here. Updated the chart of expectations for the Fed funds rate. Two things I want you to key on here. Obviously, at the bottom, if we had known just how big an impact the tariffs were going to have, we probably would have made this trade-related uncertainty bullet a little bit higher up in the pecking order here. The other thing we took pains to mention is that there was expectations that the Fed was going to be cutting interest rates this year. There's a lot of hope built into a lot of asset prices that the Fed would be lowering interest rates, but we didn't think the Fed would be cutting this year unless and until we saw a deterioration of the labor market. And as you just saw in those slides, we really haven't seen that yet. There's pessimism forming about the labor market, but we really haven't seen any significant weakening. And so the Fed has not been cutting rates and has not signaled an intention to cut rates anytime soon, despite everything that's been going on. Let's move one up to the next slide. You can see the impact that we're seeing in terms of the average tariff rate. This is from the Yale Budget Lab. We are now sort of in Smoot-Hawley territory in terms of the average tax rate that we are assessing on imports coming into the United States. Whether you think people are going to substitute away from imports from China, given that they have much higher tariffs assessed than the rest of the world on their goods coming in, depends on that. Basically determines whether you think we're at sort of a 25% rate or more like a 20% rate. But either way, these are the most stringent taxes we're seeing on imports, again, since the Great Depression. And that's having a big impact, even before some of them go into effect, on what consumers and businesses are doing. So if you look at the next graph here, we saw big spikes in January and February in terms of consumer purchases of imported goods and industrial supplies coming into the United States. These are consumers and businesses very rationally saying, we need to import more ahead of the tariffs. We don't know exactly what the rules of the road are going to be in March, April, and beyond. So this just reflects through January and February a big increase in imports, which is going to have an impact on the economic data and have the shape of the economic data as we move through. One example here on the next slide, you can see in terms of consumer behavior, car purchases. March was one of the strongest months on record for consumer purchases of autos in the US. I don't think that's because everybody's car broke down suddenly. I don't think that's because consumers suddenly got a big shot of income that enabled them to go out and buy a car. They're doing this because they think car prices are going to be higher in April, May, June, and beyond. And so this big increase you saw in March is probably going to come at the cost of weaker purchases in the spring months and then into the summer. Now let's go one more forward. And the impact on business investment here, you're looking at the year-over-year change and how much businesses spend on equipment, so capital improvements. That went down in 2018 and 2019, even ahead of the onset of the pandemic, when you saw this relatively small now spike in trade-related uncertainty. And look at the spike now. That blue line is so much higher than it was back in 2019 when we were in the trade war with China. We had a brief earnings recession. We had a brief manufacturing recession. because a lot of businesses were pulling back on spending. Think about what this black line is likely to do in the face of much, much higher levels of trade uncertainty. And this is the concern for us moving into the latter part of the year. And then the picture here for the Fed is extremely cloudy. So these policy uncertainties have a way of compounding on themselves. So we have the trade-related uncertainty, which makes it harder for the Fed to do its job when it comes to interest rates, because we're seeing this year falling growth expectations. That's that blue line. Real interest rates are declining over the 2-year tenor, but inflation expectations over the same period are going up. So if you're the Fed and you're stuck between addressing weakening growth outlook and addressing a higher inflation outlook, it's very hard to know what to do with interest rates as a central bank. And the Fed not cutting rates as aggressively as it might otherwise is making Congress's job harder. So let's talk a little bit about that. This was our checklist to start the year for what the Congress was going to have to do. They funded the government for 2025. We didn't have a government shutdown, so check mark there. All these other things are TBD. And I put this bracket here to show that the plan here is to squeeze all of these into one single bill. Raising the debt ceiling, which needs to be done this summer. New spending on some priorities that the congressional leadership has, national defense, some relief for disaster areas and border security. Renewing the Tax Cuts and Jobs Act expiring provisions, which needs to be done by January 1st of next year. Otherwise, everybody's individual tax rates go back up. And some new tax cut policies that the president campaigned on, increasing the cap on state and local income tax deductions, no tax on tips, no tax on Social Security benefits, overtime, potentially corporate tax cuts, although that's going to be a very, very hard one to get over the finish line given the expense. And then some other potential sources of new revenue from the DOGE cuts, from tariffs. It's very hard to know exactly how that's going to factor into the bill. But doing all of this at the same time is a high wire act for Congress, to be sure. And the summer months are going to be, in all likelihood, a lot of people turning their attention from the impact of the tariffs to what's going on in Capitol Hill and how they're going to get this over the finish line before the U.S. Treasury hits its debt ceiling. This is happening in the context of, if we go to the next slide, very, very wide budget deficits for a period of full employment. We are at 4.2% unemployment. We have 6% deficit to GDP ratios in Congress. And these lines for the projections from the CBO assume all the tax cuts are going to expire and the revenues are going to come back up. That's very, very unlikely to happen. So what we're likely to see is larger budget deficits moving forward than we have even today, because the likelihood is that the tax cuts are going to add to the deficit more than any potential spending cuts are going to detract from it. And that's not currently in the CBO's baseline. Same story here for the fixed income markets. A couple of concepts we had coming into the year. One was that we were not favorably disposed toward corporate bonds. Specifically, we thought they were not trading with enough of a yield premium to things like treasuries to be worth a lot of investor dollars. Those spreads have widened out, especially following the Liberation Day tariff announcements, as people became less certain about the economic outlook and liquidity concerns crept in as well. Even before that day, investment grade and high yield corporate bond spreads were widening out, and those asset classes were underperforming. We talked about diversifying within taxable fixed income portfolios, owning things like taxable municipal bonds, mortgage-backed securities. Those are held up relatively better than the corporate market. One line to note here, the municipal bond line. Munis had been underperforming in March. Seasonality is a big deal for munis in March. A lot of issuance, waning demand for sure. And then the liquidity issue that we had in early April hit munis very hard, because munis tend to be less liquid than a lot of the rest of the bond market, certainly than treasuries. And you see that big downward spike came as the liquidity in the municipal market dried up. We have seen it begin to recover. We still have a favorable view on the asset class, especially for investors with tax sensitivity in their portfolios. But munis have underperformed, again, for a variety of reasons, due to calendar issues, concerns about the high level of issuance that we've seen in the municipal bond market, and also issues related to liquidity. One point on the corporate bond side, then I'll stop. We've seen this spike in the spreads on both high grade and high yield corporate bonds. They don't even rise to the level of where they were back in 2002, let alone the very distressed levels that we saw in the global financial crisis in 2008. So still not attractive here for us, despite the fact that we've seen wider spreads now in the wake of the tariff announcements.
So just turning to equities, we want to start by kind of looking back at our themes entering the year for 2025. We talked a lot about how we should be mindful of the great expectations in markets. We saw crowded positioning, stretched valuations, and pretty optimistic sentiment, which could set us up for disappointments throughout the year. And while a lot of these metrics have recalibrated here in the last 6 weeks, we think maybe there's still a little bit of room to go. So what's fascinating is the first 6 weeks of the year, we actually had a pretty solid start for the S&P 500, one of our better starts on record. Since February 18th, however, the market has certainly given back much of those gains, and now we're off to our fourth worst start in the last 100 years in the S&P 500. I think one encouraging point, though, is that historically weak starts do not always make for full year weak markets. About 70% of the time, the market has been higher for the remainder of the year by an average of 18% on the S&P 500 following those 10 worst starts to the year. So some other stats we'll touch on, but also, what we said for equity investors, this might mean being comfortable, being uncomfortable. We should expect greater uncertainty, both from a policy standpoint, from a market volatility standpoint, probably see greater dispersion across markets. We have seen some of that play out this year, which we'll get into. And what we said that meant for investors is probably to reduce some of that concentrated positioning, look to capitalize on the benefits of diversification, not take too much beta or risk in your equity allocation until we saw some resets in some of that crowded positioning, and ultimately focusing on higher quality across sort of global equities. Higher quality companies tend to be great at weathering those challenging economic periods and volatile periods in the markets. And then in terms of our current positioning, looking to kind of remain where we entered the year, saying, we think there's still a lot of benefit to having a balanced approach between value and growth. We like sort of migrating up in capitalization, so focusing on larger cap relative to the smaller cap segment. And then just looking to international equities as a place for diversification to sort of sidestep some of this U.S. equity market volatility. And as you can see in the chart on the right, we have seen a lot of dispersion this year in global equity benchmarks. That dispersion is one of the reasons why diversification is working really well. But maybe on the next page, Cameron, we can talk about the scenario analysis. We had this page in our year ahead outlook. What's interesting is we've sort of slowly moved here from the center of this scenario analysis, where we entered the year trading at 5,700. We traded up to around 6,000 on the S&P 500. That was around 22 times forward, forward estimates that were pretty lofty. We've since repriced here as earnings expectations have moderated, as valuations have come down due to all the uncertainty in the market. So still a wide range of outcomes. We said that's certainly possible this year, but I think as long as the uncertainty remains high, that likely acts as an anchor on overall market valuation. That also probably presents challenges to the earnings environment, as Cameron talked about, with operating margins still expected to be pretty high this year. Turning to the next page, I wanted to show how all this uncertainty and volatility ranks relative to history. Certainly, we've seen some record levels of policy uncertainty in recent weeks. We saw the VIX trade above 45 for 3 straight days 2 weeks ago, sort of right before the tariff pivot from the administration. The good news is typically uncertainty and volatility have historically been good periods to be adding to equities. If you look at the 8 most volatile periods in history, one of which we saw 2 weeks ago, historically, the market's been higher a year later, 8 out of 8 times by an average of about 12%. So I think there is merit to looking at equities when the sort of consensus is fearful, but we think there may be a little bit more wood to chop there. And then looking at positioning and sort of sentiment, we have seen this substantially reset. If you look at when we entered the year, we saw consolidated equity positioning was closest to the highest levels on record. We have since seen that reset now in the last couple of weeks to sort of a much lower level of positioning, suggests that some of these crowded trades have been unwound. We have seen some capitulation in markets. If you look at sort of the percentage of companies trading above their 200-day moving average, 2 weeks ago that reached about 15%. That level has historically coincided with a lot of market lows in the past. If you look at the sort of the last 6 market sell-offs, when we see that level of breadth deterioration, typically you see markets bottom. Doesn't mean we're always in for a V-shaped recovery, but it does suggest that being more opportunistic in equities can be rewarded. And I'd say one of the risks and one of the things that gets us a little bit more cautious or reluctant to be more bullish on stepping into equities here is that valuations, while they've recalibrated, they're still above sort of the long-term average of around 17 times. So when we say there might be some more room to go here on this valuation recalibration, this is what we're looking at. And I think that you can make the case that the S&P today looks a lot different than it did 20, 30 years ago. We're much more services oriented. A lot of the companies that dominate the S&P 500 are more profitable than they have been historically. So while I think the valuations can stay elevated, I do think that we're not quite at a point where you call the market attractively valued. And another headwind to markets has been the earnings revisions or the expectations for earnings growth for 2025 and 2026. This had been a tailwind to equity markets over the past 2 years. In the last couple of months, we started to see these estimates roll over, reflecting some of the economic concerns out there. This is not always a great market timing tool, but it just suggests that there is another headwind that we need to be mindful of. And when earnings revisions stop going up, it likely means that the market has trouble continuing to go up. And as you see on the next page, we have seen these earnings revisions on the S&P 500 level off. It's not just within the S&P 500, it's a lot of companies that have seen this trend and leveling off, but also the Magnificent Seven segment. This is one of the most powerful groups in the market. Those 7 companies account for about 30% of the S&P weight. They've accounted for over 50% of the S&P return over the past 2 years. And that group has now started to see their earnings expectations for 2025 and 2026 come down a little bit. Maybe we can talk more about the Mag 7 at the end of this section, but just a couple headwinds to note there. And I think when we see these headwinds and all this uncertainty and volatility, it's important to think about the long-term trend in equities and why we are equity investors. And it's to benefit from the power of compounding, and it's not to be shaken out when we see these levels of volatility. And what this chart looks at is that the 200-week moving average on the S&P 500 going back to 2000. Historically, the 200-week moving average has been a good time to be buying into equities. We've traded around the 200-week moving average about 6 times in the last 2 decades. 2 of those 6 times were the financial crisis and COVID, as you can see in the chart here. It doesn't always mean that will bounce off that support level, but when we see these growth scares in the market, typically we trade down to this level of support, and it's acted as a pretty good place for equity investors to be putting money to work. And so on this chart, you can see that the 200-week moving average is around 4,700 on the S&P. That might be a point if we get there that we would say that the risk reward is certainly more attractive. Doesn't mean we can't bounce off where we are today either. We've seen that happen in the past as well. And then also framing the constructs around S&P 500 and looking at prior drawdowns or corrections of greater than 10%. When we see these corrections of 10%, there have been 20 of these since 1950. And while the max decline has averaged around 20%, the average 1-year and 3-year returns off of these 10% corrections that we've seen in the past have actually been quite strong, averaging 11% over the subsequent 12 months and 37% cumulative over the subsequent 3 years. So I think it's important to understand that volatility and corrections are part of being an investor in equities. Certainly, corrections can turn into bear markets. That happens about 20 to 25% of the time. But even bear markets are not necessarily a reason to panic or sell equities. We've seen 11 bear markets since 1950. They occur about every 5 to 6 years on average, although we've seen 3 now in the last 5 years. So we've certainly been dealing with these more frequently than we would have expected. The average bear market decline is around 30% on the S&P 500. Typically, those bear markets caused by geopolitical shocks and policy are not as severe as the ones that are caused by bubbles bursting or true financial dislocations. But even if you had invested at the start of any one of those bear markets in the last 50 years, your returns would have been higher a year later, and 8 out of 11 of those bear markets by an average of 17%. And then the last point I'll leave you with is just the 5-year annualized returns on equities are actually higher at the beginning of bear markets than they are in any other period, averaging about 12% annually. So just a couple thoughts there to kind of frame the volatility and the correction we've seen in equities and the case for being a long-term investor. But I also think it's important to know when you are invested in equities, there's ways to provide some protection against this volatility, and that's this emphasis on the higher quality segment. Higher quality stocks tend to do really well in uncertain environments. They're companies that are adept at creating shareholder value. They tend to have great business models. They're capital efficient. They tend to generate a lot of free cash flow, which helps them weather difficult economic environments. So when we talk to a lot of our clients about having quality equities as a core piece of your allocation, this is the environment, and this is really the thesis playing out here in the near term. You see that the earnings power of that higher quality segment is certainly stronger than the broader market.